Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today. We're going to talk a lot about not only the economy, but we're going to talk a lot about investment questions that you have and answer those questions and make sure you make the best decisions possible around your retirement and your financial position. You know, I've been managing money well over 30 years. Rezny Wealth Management is a fee-only fiduciary money manager. And let me just kind of explain the difference. We're not a Wall Street style firm. We're not a bank. We're not an advisor. We're an actual money manager. In our estimation, less than 10% of firms or so-called advisors are really fee-only fiduciary money managers. So we actually manage money. Most advisors in Wall Street firms and banks really sell product, and they're really customer service reps and not money managers at all. So there really is a big difference. And I think investors need to understand the advice you're getting may not really be advice at all, and it may be sales. To learn more about real money management or real advisor versus a fake advisor, go to ReznyWealth.com, click on the Special Reports tab, and download for free Real Advisor, Fake Advisor Report. Educate yourself, protect your money. One of the things that often happens is this. Investors have a lot of concerns, and often they're not happy with the current advice, let's say they're currently receiving. They're not happy with the performance of their overall portfolio, and they really are not making a change to better that performance or that current situation. So let's talk just a little bit about that. You know, last year, for our clients, generally speaking, I thought it was an excellent year, and we have very happy clients at Rezny Wealth Management. We had a lot of new people hire our firm last year, but we have that every single year. A lot of people call us from our TV and radio shows because they're just not happy with the current advice they're getting, and they think they can do better, and they realize there could be a better opportunity elsewhere. You as an investor is the only person that can ultimately make that decision. Now, one comment that I had from a recent interview that interviewed my firm to hire us was, you know, my portfolio's done okay. That was his general comment. I actually was up last year, but the question I posed for him was, well, how much were you up? So maybe your portfolio's up and you made 8%, but given your risk profile, you should have made 16%. So maybe your account's going up in value, but it should have done twice as well given your risk in those portfolio and also your risk objectives. So this is important for people to understand. People often be a little complacent and they'll say, well, I made money, so maybe I'll do nothing. But again, if you were supposed to make 16% given your risk and you only made 8%, that's not a good scenario. So if you're not happy with the advice you're getting, it's smart to learn, educate yourself, and get that second opinion. Reviewing your investment objectives for every investor and retiree is vitally important. If you're trying to secure your retirement income, you need to look at your investment objectives. And let's talk a little bit about that retirement income. Where does that come from? Does it come from pure income investments? No. It can actually come from growth of your portfolio. One of the things I try to educate every investor, if you're a pre-retiree or retiree, you want to strive for what's called total return. Growing your assets, generating income, the combination of those two give you what's called total return. Total return, in our opinion, is a much more stable income base because now you have the opportunity to beat inflation, grow your money, and give yourself an increasing income over your retirement. Remember, the average retiree couple who retires at 65, one of you is going to live into your 90s. You're talking about a 25 to 30-year retirement. If your money is not growing sufficiently, you're not going to grow your retirement income, and then you start to spend down principal too quickly. 5-10 years in retirement, you can be in some deep trouble. So think about total return, growing your base, your asset base, so you get a growing retirement income to beat inflation over time. Lyle in Florida, what do you think of something like this? The Dirksian Daily NVDA Bull 1.5 shares. It's up over 60% year to date. Lyle, what you're talking about is a leveraged, meaning margin, leverage, something that I really try to discourage clients from doing, generally speaking. One thing that I will say is this. Investors that ask about levered ETF or levered investments or borrow a lot of money to buy investments because something has already done well, that's usually a recipe for disaster. I've been managing money for over 30 years. Often, and I'm not saying this is a market top by any stretch of the imagination, but I will say when I start getting questions, Lyle, like yours, where people are basically chasing investments just because they went up a lot and that are levered and on margin, often get burned in a bad way. You want to make consistent returns on your portfolio over the next 5, 10, 15, 20, 30 years. By doing risky speculation investments, you're going to often lose more than you'll ever make. Learn from others' mistakes, it's less costly to you. Having investments in your portfolio where you're taking on margin in your account, whether you have levered investments that are 2-3 times levered, makes zero sense. You're also talking about a semiconductor stock that is very highly valued. Now, fair disclosure, we do own NVIDIA in our client portfolios, but again, it's within a balanced measure and it's not levered up. Be cautious with what you're doing. Market Fort Myers, Florida. What happened to value stocks? They were supposed to be the go-to growth stocks or outdo growth stocks last year, but they didn't. How will this work this year? Great question. Mark, there's two types of areas that I want to explain to investors. We call it value stocks and growth stocks. From time to time, value stocks will outperform growth stocks. Value stocks are usually stocks that are growing earnings less than the overall market multiples or the average stock, let's say in the S&P 500, but they're trading at a valuation, let's say a price to sales, price to book, price to PE less than the S&P. So sometimes those are considered value stocks. And then you have growth stocks, which are usually growing earnings faster than the S&P, but often trade at a premium to the S&P benchmark. So neither one is necessarily good or bad. What we believe in is looking at valuation, but also coupling that with relative strength. Some people call it momentum. The trend is your friend when it comes to investing. There has been many periods of time where value stocks outperformed growth stocks, and there's been many times and long periods of times where growth stocks have outperformed value. What I would say is, as we are now in 2024, my firm belief, I still believe we're in that relative strength momentum phase where growth stocks will continue to outperform value in 2024. Barbara in Naples, Florida. Given the recent fluctuations in the stock market, should I rebalance my portfolio to maximize return? Barbara, it's always good to rebalance your portfolio. One of the biggest mistakes investors can make is blindly buying, let's say, 10 different investments, putting 10% in each investment, and just letting that ride. And letting one investment just dominate the whole portfolio because it's done so well without rebalancing that portfolio back. Again, I talked about momentum earlier. So when you're managing a portfolio, we look at a lot of metrics on valuation, but we also look at direction of those investments. But we want to make sure that we do not over-concentrate the portfolio in one particular stock or sector, because when that stock or sector does come down, it's going to really wreak havoc on the overall portfolio. So rebalancing keeps your portfolio in check, keeps you averaged out in those holdings, and it pretty much forces you not to overweight one stock or one sector overall. I'm going to go to a quick commercial break. Go to ReznyWealth.com, download any of our groundbreaking reports. Our number one downloaded report for 2024, the 3 biggest risks you must avoid now. If you care about your retirement, if you have at least $1 million portfolio or greater, if you're somewhat questioning the advice you're getting, if you had a mediocre year last year in returns, maybe a mediocre year the last 2 or 3 years, you're realizing your portfolio maybe is not being managed the way that it should be. This report will help open you up, give you the education so you can make better retirement decisions. Go to ReznyWealth.com, click on that special reports tab. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program, and as I've always said, learn from others' mistakes. It's less costly to you. And one of the things I do want to stress is sending your questions to Brian Rezny at ReznyWealth.com. We want to make sure that you get your questions answered so you can make better financial decisions. I think too many investors today, unfortunately, get a lot of information either off the internet or kind of spam emails that are sales propaganda about, buy a bunch of gold or buy Bitcoin. You really need to make sure you understand what you're purchasing in a portfolio and do proper research before you buy any investment. Because if you get into the speculation craze, that is often leads to poor investment performance and major losses in a portfolio. One of the things that I think is important for a lot of you investors out there is really evaluating your advisor and your communications. We hear this often from clients that hire our firm. Brian, the current firm I utilize, they just don't communicate with me. I really don't know what's going on. I really don't know how our portfolio is done or what they're thinking of the overall general economy. Those kind of comments from people that hire our firm is why we have excellent client communication to all of our clients. You need, as a client, to make sure you understand what's going on with your portfolio. You, as a client, need to understand how we, as a money manager, view the global economy, the U.S. economy, and the investments within a managed portfolio account. I think investors today become frustrated from a lack of quality educational material that they can truly understand. That timely information from your advisor is vitally important so you can feel comfortable with the way your money's being managed. We realize that. For managing money over 30 years, we've always had great client communication because we realize you, the client, need to understand how you're doing and how we, as a money manager, again, are assessing what's out there and what obstacles and problems we need to avoid and what opportunities are best for your portfolio. Let's talk about assessing your portfolio allocation as an investor. This is often a big one. Unfavorable risk-adjusted returns. I talked about this a little bit earlier. You might be one of those investors who say, well, I've got $1 million and my portfolio went up last year, but it only went up 8% and you're a growth portfolio, and maybe you should have made 18%. So the key is, what's the risk of your allocation or your portfolio? And are the returns of that allocation in line, essentially, with the risk you're actually taking? So if you're taking a level 8 risk for growth and you're making level 5 returns because of poor investment choices by the firm you're utilizing or investments they're selling you, that's not a good scenario. So just because your account's up, maybe it should have been up quite a bit more. What are you leaving on the table ultimately, and what's that costing your financial security? Maria in Florida, I enjoy listening to your Sunday show. How do you feel? Do you feel it's a good time to purchase XLE? Thank you. Maria, first off, we do own positions in XLE. It's an ETF that owns a basket of energy stocks. I firmly believe energy is going to be a growth industry, which it has been for a number of years. We like energy and we do own XLE. But I will say this, we're looking at the election coming up down the road, and depending who gets into office and what their policies are around energy, we may trim our position, we may add to our position, or we may completely eliminate our position. Remember, one of the things I talk about all the time, just because you buy an investment that is appropriate today doesn't mean it's going to be appropriate under the next leadership in the U.S. We may be selling that position. Right now we like it. We think there's great opportunity in energy. And energy is going to be around, oil and gas is going to be around for decades and decades, if not centuries to come, because there's no cheap alternative to replace it at this time. James in Fort Myers, Florida. What is the best way to ensure my advisor is choosing investments that are good for my account? James, first off, the firm you entrust your money to has to be a fee-only fiduciary money manager. If your advisor is tied to a brokerage house, a bank, an insurance company, they would not be a fee-only fiduciary money manager. So the way you ensure that your advisor is choosing proper investments is they cannot have conflicts or sales incentives to utilize investments that their broker-dealer, their custodian, their clearing firm requires them to sell. Think about this. If you work with any big bank, insurance company, or brokerage firm that sells mutual funds, how did those mutual funds get on their shelf? Those mutual funds pay what's called a shelf space fee to get on that brokerage firm's list. Once they pay that fee, they now have access to that advisor at that firm that then can sell it to you and put it in your account. Is that the best mutual fund for your account? Or are they selling you that because they have a sales agreement now with that mutual fund company? All the brokerage firms do this. The banks do it. The insurance companies do it. Not what's best for you, massive conflicts. So again, the only kind of firm you should ever entrust your money is a fee-only fiduciary money manager. Go to ReznyWealth.com, click on our special reports tab, download for free Real Advisor, Fake Advisor. It'll teach you the difference, and it also gives you the 2 websites you need to check out your advisor to see if there's misdoings against that person or their firm against clients like you. Philip in Fort Myers, Florida. What do you think about Coca-Cola, symbol KO stock? I own 10,000 shares. I think Coke's a decent company. I don't own it as an investment. And first off, you own 10,000 shares. What percent of your portfolio is comprised of Coca-Cola? If it's more than 5%, you need to immediately trim your position down to 5% max. I think there's way better opportunities than Coca-Cola. The price of Coca-Cola, price to sales, price PE ratio, things of that metric, the stock is clearly overvalued. It's a kind of a medium growth stock. It's not great growth. It's not terrible growth. It's just kind of okay. So again, it's not a stock we would own. It would be a stock that I would tell you to sell completely, but at least trim your position down to 5%. There's many greener pastures for your money than Coca-Cola. We can talk more about that later on. I'm going to go to a quick break. As always, send your questions to Brian Rezny at ReznyWealth.com. We love hearing from you. We like answering your questions and making sure you stay on track. And as always, go to our website, ReznyWealth.com. Click on that special reports tab. The 3 biggest risks you must avoid now. If you're a pre-retiree, retiree, if you're at all concerned about the advice you're receiving, if you're having second guesses about your portfolio, maybe you're self-managing, you have $1 million or greater, this report is a must-read. Protect your money from bad advice. Learn the mistakes too many investors unfortunately have made. Learn from others' mistakes. It's less costly to you. Go to ReznyWealth.com, click on the special reports tab, download that report. It's free, it's educational, it's a must-read. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's show, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, one of the things that I think is important for every investor to realize is every single year, the equity markets, the stock market, the bond market, real estate, gold, all investments have volatility. Just remember that. Nothing goes up in a straight line. If things go up too quick, expect some kind of pullback, which is healthy in the market. Statistically, all asset categories, not just stocks, but also bonds, can have 5, 10, 15% corrections every single year. Does it mean they're down for the year? No. You could be up 3% for the year, pull back 10, retrace that 10 and go to new high ground and end the year up 8% net for the year. That's how the markets work. And again, not just the equity market, but the bond market in addition. I think too many investors often expect things only go up, and when things come down, or they listen to a lot of rhetoric or emails now you receive in your inbox about the recession is imminent, this is going crazy, and all these different things out there that people really are kind of spoon-fed today, investors make emotional decisions off of those news headlines, and it's very detrimental to your financial security and also obviously your net worth. Investors that make emotional decisions have a lot less money. I'll tell you a quick story. I had a gentleman that came into my office just a few weeks ago, and he was self-managing his own money for a while. He hired a firm to then manage the money. He told me that he had 2 different times liquidated his portfolio when the market dropped, like 2008, and basically bought an annuity because he thought things were going to keep going down. So he basically repeatedly bought at the top, sold at the bottom, bought annuities, and then realized the annuities were garbage, wasn't making any money on those, and then would go back into the market when things were all rosy again. Those are the emotional decisions that are detrimental to your wealth, and you don't want to make those. Let's explore alternative advisors and investing action that you, the investor, need to do. Seeking options is critical for your portfolio, and seeking an advisor that has your best interest at heart is vitally important. There's 2 standards, essentially, that investors look at. They look at the fiduciary standard, which means that firm has to legally work for you in your best interest 100% of the time, and there's called the best interest standard. What does that ultimately mean? One standard, the fiduciary standard, that advisor has to work for you legally 100% of the time if they're a fee-only fiduciary money manager. If they're working with you in the best interest, if they work for a bank, insurance company, brokerage firm, that is not a fee-only fiduciary money manager. So essentially, are they doing what's best for you 100% of the time, or are they really just selling you things you're suitable to buy, but are not the best investment in the marketplace? Remember, only you can do the due diligence necessary to pick the proper firm to protect your money and manage it correctly. Sales jargon, a sales pitch, like the last comment of the gentleman who went to cash 2 different times and bought 2 different annuities and then realized that was another blunder mistake. He was sold by a so-called advisor who worked on his emotions. You, the investor, have to realize you have to make proper decisions around your portfolio. Make sure the only kind of firm you entrust your money to is ultimately a fee-only fiduciary money manager. Let's understand the crazy world we live in with investing today. You know, I often get a lot of comments on my TV radio shows about, man, there's so many things going on. All these geopolitical events you're hearing about. Israel, Hamas. You're hearing things with North Korea again. You're hearing things with Iran. All these geopolitical events. Folks, we've always had issues going on in the world. Go back 50 years, 100 years, 200 years longer. There's always geopolitical events going on. It's unfortunate, but it's fact. So really, when you're managing a portfolio, you need to realize geopolitical events are part of a natural process. Again, these are not necessarily good scenarios, but you have to deal with these when you're managing a client's portfolio or if you're managing your own money. How do you deal with a geopolitical event? It's pretty simple. You have to make sure you keep your emotions in check and you don't make decisions based upon what's going on today. I remember, and which was a sad event, when we had 9/11 here in the U.S., when we were ultimately attacked by terrorists at the Twin Towers in New York. The markets actually dropped about 12 to 15%, literally in a couple-week time frame. Sad event, a lot of great Americans lost their lives. But what happened with the overall market? While it did drop from that geopolitical event, it actually rebounded quite quickly and, of course, went to new highs within a year and continued to go higher. So do you react to a geopolitical event? Do you sell everything? Or is it maybe an opportunity to better positions in your portfolio and do the right thing for your money? Mike in Cape Coral, Florida, what do you think about Alibaba stock? Alibaba is a Chinese stock essentially. And Mike, I'm going to say this. Stay out of investments in China. China is a communist country. The information you get about companies within China, they don't have the same standards they have here in the U.S. So you'll get information, But is it factual information? Is it kind of skewed information? How good is that information? I think you could diversify properly within the U.S. without buying Alibaba, and I would avoid investing in China completely until at some point in time, which will probably never happen, they actually get their act together, they have clear accounting standards like we do in the U.S., so you, an investor, can actually do proper research and actually know what you're buying because of research, not because of maybe propaganda that factually maybe half of it isn't true. Lisa, Bonita Springs, Florida. Should I be accumulating Devon Energy during the dip? Lisa, one of the big things I want to stress to you is this. If you're going to buy an individual stock, just because it went down doesn't mean you should buy it. You should buy Devon Energy because it looks like it's going to rebound based upon earnings and revenues. Okay? If you buy individual stocks, you'll have more volatility than if you buy a basket or an ETF that owns Devon Energy. So what I would say to you is this. Would I buy Devon Energy at this point? No. Would I look at buying a basket of maybe energy or utility type stocks? That would be a better opportunity, I think, for your portfolio. I think too many investors think stocks are the only way to go. I think if you have the time, discipline, and talent to own individual stocks and you continue to research those before and after you buy them, which does require a lot of time, knock your socks off. But I think a lot of investors would be better off with a broad basket like an ETF format. I think it would be much smarter in your overall portfolio. Tom in Estero, Florida. Should I sell PayPal? I bought it 3 years ago. It's down 70%. Tom, fair disclosure, we actually bought PayPal maybe about 3 months or 4 months ago. So we bought PayPal when it was already down a lot. We like PayPal. We're cautious on it. We're looking for a rebound as the company continues to grow, and we're looking at how the company performs financially. Recent reports have looked good. The stock is very inexpensive, but that doesn't mean it can't get more inexpensive, meaning it can't go down more. But we like the stock. We're watching it closely. We do a lot of research on it. I think you, if you're down 70%, you may want to consider selling the stock. Take your tax loss, do better research, and after 30 days, rebuy the stock. So at least you can take the tax loss now, rebuy the stock if you really like it and you've done research, and then look for a recoup in the overall value of PayPal. But great question. Folks, I'm just about out of time. As always, go to ReznyWealth.com. If you're unhappy with the advice you're getting, if your portfolio is at least $1 million and greater, as we manage larger portfolios, give our office a call. There's no reason you should suffer with poor client communication, poor investment management, lack of returns. If you at all are doubting the ability of your current firm or advisor, call my firm. Let's sit down, discuss our services, your portfolio. Let's get you back on track. Honesty, compassion is vitally important when you're working with a client, and competence within the money management field. As always, go to ReznyWealth.com, click our consultation tab, or give us a phone call for a consultation. Have yourself a safe and profitable day.